Starting a new chapter after a marital separation, that's complex enough on its own. You're focused on the emotions, the logistics, all of it.
Yeah.
And what often gets completely sidelined until that IRS deadline is staring you down are these massive critical tax decisions that will shape your financial future for years.
And that's really why this deep dive is so essential. I mean, the financial fallout of divorce is usually handled by the legal system, but the source material we looked at gives this incredibly sharp, practical focus from a tax preparer's perspective.
Okay.
So our mission today is to cut through all that emotion and give you some actionable, numbers-based strategies, those aha moments that can lead to real financial efficiency.
Yeah, and we've synthesized insights from a seasoned tax professional who, they handle the full spectrum of complexity that a married life leaves behind.
That full picture.
Exactly. We're talking about optimizing deductions for children, figuring out real estate, untangling businesses, even managing college education expenses and student loans.
And if we start with one foundational principle from all this material, it's this. The ease with which you can resolve these tax issues is directly correlated to the level of amicability in the divorce.
So the friendlier the split, the better the tax outcome.
The source material is unequivocal on this. The more contentious the separation is, the harder it becomes to find resolutions that are not just fair, but, mathematically optimal for everyone involved.
It sounds great in theory, just be amicable, right? But the tax preparer is asking former partners to cooperate on a level that feels almost impossible during a separation. How do they actually manage to enforce this core strategy of eliminating emotion?
Well, they don't enforce emotion, they enforce math. The tax preparer's role is really about helping couples get to a neutral zone, a place where they can take the emotion out of the divorce experience.
And just look at the numbers.
Just look at the pure numbers, the financials of it. They frame it not as a compromise of feelings, but as an optimization of the tax code.
Okay, let's unpack this. If you can focus purely on the objective math, what is the biggest quantifiable benefit?
The biggest benefit is finding the single scenario that generates the lowest total tax bill for both parties combined.
Ah, for the unit, not the individuals.
Exactly. When couples refuse to share information or, engage constructively, they often end up duplicating deductions or canceling each other out or just leaving significant tax benefits on the table out of spite.
Or just miscommunication.
Or just miscommunication, yeah. If they run the numbers collaboratively, they can figure out what genuinely makes the most sense before they sign that settlement agreement.
Which allows for better resolution on everything that follows.
Right, because the argument shifts from a personal grievance to, provable numerical superiority.
Okay, let's jump into the most common conflict area when kids are involved, the dependent calculus. Who claims the kids? This is critical for filing status, for credits, for deductions.
And what's truly fascinating here is the surprising, almost counterintuitive approach suggested by the source. Even after a divorce, the professional doesn't just ask who has primary custody.
Which is the default role, usually.
It is, but they ask, which scenario benefits the most overall for the overall family to take the children as a tax deduction? They treat the former couple's finances as a single unit to maximize the benefit, and then they allocate it.
That completely shifts the conversation. It's no longer a battle of ownership, but a strategy session on cash flow.
Precisely.
So let's break down the specific technical implications here, because it goes way beyond just the $2,000 child tax credit.
Absolutely. The first major implication is filing status. You have to distinguish between filing single and filing head of household.
And that's a big difference.
It's a huge difference.
Yeah.
Filing single gives you a standard deduction, say around $14,600 for 2024. But filing as head of household, that often jumps the standard deduction up to over $21,900.
Wow, okay. That's a massive difference in taxable income.
It is. And only the custodial parent who meets certain criteria like paying more than half the cost of keeping up the home can claim head of household. The dependent is the key that unlocks that status.
So even if the child tax credit itself is split or alternated between years, that head of household status is a massive prize in itself. How do they manage the actual claim for the credit? Do they just recommend alternating years?
That's the classic strategy, yeah. Alternating the dependent claim. They use IRS Form A332.
Right.
It allows the custodial parent to release the claim to the non-custodial parent. And the strategic benefit here is, it's complex, but it's vital. The value of a tax credit is highest when the claimant can fully use it. which often means their income is below the phase-out threshold.
Okay, and this is where it gets really interesting. You might alternate the dependent year to year so both parents benefit, but you might also strategically place the dependent with the parent who has the higher income.
Right, if that income still falls within that sweet spot for the maximum credit.
Or with the parent who's claiming education deductions.
Exactly. If you have older children in college, claiming the child ties directly into education expenses, like the American Opportunity Tax Credit.
Which can be thousands of dollars.
Thousands. And those credits must be claimed by the parent who claims the child as a dependent. So the tax pro will run projections to see which parent's income bracket benefits the most from all of it.
And we can't forget the smaller credits, the ones people use all the time.
Right. Beyond the big ticket items, our source reminds us of the dependent care credit.
For daycare, after-school stuff.
Yeah, if you have younger kids and after-school activities, summer camps, daycare, all those common expenses, this credit helps offset those costs. And that credit is directly tied to the parent who claims the child.
Okay, before we move on to assets, there's a massive piece of the financial pie that has huge tax implications. Spousal support, alimony.
Yes, and it has to be addressed, especially because the rules changed so drastically a few years back. For any divorce or separation agreement executed after December 34, 2018, alimony is federally neither deductible by the payer nor taxable to the recipient.
That's a complete game changer.
A total game changer. The source stresses that the first thing a tax preparer must do is confirm the date of the agreement.
So if your agreement was from, say, 2017, the payer is still deducting it, the recipient is still claiming it as income. But for newer divorces, it's just a cash transfer. The payer loses that valuable deduction.
Precisely. And this is why that pure numbers analysis is so critical. While the federal rule is clear for new agreements, some states, I think New York or Massachusetts are examples, their state tax codes still treat alimony the old way.
So it's still deductible and taxable at the state level.
It can be. So you, the listener, you have to confirm your specific state rules because that determines the final actual cash flow in both households.
Okay, that covers cash flow and dependence. Let's transition now to the big assets. Real estate is almost always the largest asset, and how you divide it has a huge bundle of potential tax benefits and pitfalls.
For sure. And the focus here is on two critical areas. First, the annual deductions, and second, the massive capital gains exclusion when the house is eventually sold.
Let's start with the annual stuff.
Okay, so for the annual deductions, the professional has to make sure those tax questions are resolved clearly. If one person keeps the home, they need to know who takes the deduction for real estate taxes and who claims the mortgage interest deduction.
And those deductions have to be tied to who actually pays them and who is legally on the hook for the loan.
Right. If both names are on the mortgage, but only one person is making the payments and living there, that has to be explicitly documented.
But the much larger concern isn't the annual deduction, is it? It's that capital gains exclusion.
That's the big one. When a marital home is sold, you generally get to exclude up to $250,000 of profit, or $500,000 if you're filing married jointly.
Post-divorce, that $500,000 is typically split into two $250,000 exclusions for each person filing single.
Right, and this is a huge potential tax event. If the house is appreciated a lot, say $400,000 in gain, and one spouse moves out, and then 5 years later the house is sold, how does the IRS figure out who qualifies for the exclusion?
There's a test for that, right?
Yes, a specific test. You must have owned and used the home as your principal residence for at least 2 out of the 5 years ending on the date of the sale. The source emphasizes that in divorce settlements, the departing spouse can sometimes treat the home as their residence for capital gains purposes even after they move out.
So they can still get the exclusion?
Yes, provided the house is eventually transferred to the other space as part of the settlement. That detail needs to be hammered out and legally documented to avoid a massive tax bill years down the line.
Because if that piece isn't settled correctly, the spouse who moved out could suddenly owe capital gains tax on their half of the profit.
Which would be a colossal failure of financial planning.
Absolutely.
And we also have to factor in rental income. What if, instead of selling, the couple decides to rent the property for a few years?
Then it becomes a business asset.
It does. They have to clearly delineate who gets the rental income, who claims the related deductions like depreciation and expenses, and how all that affects their individual tax returns.
Speaking of business assets, this is where it gets really interesting. Business separation. If a couple ran a business together, untangling that is exponentially more complicated than just selling a house.
Oh, it certainly is. because the business is a living, breathing financial entity. It has its own tax obligations. The source material outlines two main scenarios that have to be worked out, and both require a lot of valuation and cooperation.
The first, and I guess the cleanest path, is the buyout.
Yes. Does one former spouse buy the other one out?
Hmm.
The complexity here is massive. You have to determine if the payment is treated as a marital asset division, which is generally a non-taxable transfer,
Or,
or if it's treated as the sale of a capital asset, which would trigger capital gains tax on the profit from that sale. The distinction is critical, and it all hinges on the settlement language.
so if the departing spouse is selling their ownership stake, say in an S corp, that's usually a capital event. But if it's just balancing the marital estate, it might be tax-free.
You need a tax professional involved to make sure the structure of that transaction dictates the favorable tax outcome. No question.
And the second path is often the most surprising and maybe the most difficult to maintain. Do they continue to run the business together?
It happens more often than you would think, especially with professional practices or, long-established family ventures.
That requires an unprecedented level of ongoing partnership and coordination.
Not just that, but clear guidelines on the division of profits, operational control, and crucially, who handles the taxes for the entity itself.
And the K1s they each get.
And the K1s.
Yeah.
I mean, continuing to co-own a business means linking your finances indefinitely, which sort of runs counter to the whole spirit of a separation.
So what does this all mean for you as you're navigating this incredibly complex landscape? We've covered ground from dependent calculations to the capital gains exclusion and the new rules on alimony.
It means synthesis is mandatory. You have to prioritize clear, calculated decisions across all of these major areas.
Who claims the dependents? What's the best filing status?
Right. How are the real estate deductions and capital gains split? And is a business being bought out or co-managed? Ignoring any one of these guarantees some future financial pain.
And the final takeaway from the source material is straightforward, and it really reinforces that core strategy we started with. The best way to handle this process is by really sitting down, crunching those numbers, looking at those numbers.
It's a mandate to prioritize objective logic over an emotional reaction.
It is.
And if we connect this one last time to the bigger picture, the source stresses calculating the financial benefit for the overall family. And this raises a really important question for you, the listener. Given that mandate for collective optimization, what does it truly mean for former partners to continue viewing their decisions through a lens of shared financial benefit, even when they're legally separated? That level of required long-term financial transparency and communication, often involving sharing tax returns and income statements. It goes so far beyond the typical expectations of a former spouse.
And that's the true ongoing cost of optimization that you have to be prepared to manage long after the divorce papers